Good afternoon, everybody. I'm Dan Hussey with Zaner Ag Hedge, bringing you our Strategy of the Day update here for August 31st, 2021. Remember, trading futures involves risk and is not suitable for all investors, and everything I talk about here today is just my own opinion and not a direct trade recommendation. We're going to take a look at some South American weather. Not really much to speak of there, but we'll get into that first. We'll look at the dollar index, corn, wheat, and beans, and how the price action today might be indicative of a little bit of a top forming. And of course, if you want to get more involved with what we have to offer over here at Zaner Ag Hedge, check out in the comment and in the profile section of this video, and click on those links to join either our Strategy of the Week webinar mailing list, where I go over every Thursday at 2 p.m. actionable trading strategies that you can take advantage of in these markets, as well as joining our newsletter, which is completely free, to get our entire team's commentary on current market price action. So, with that being said, I guess let's just take a look at weather, because in my opinion right now, our South American forecasts are now more important than I think our North American forecasts. There isn't much in the way of rain to be expected. However, it looks like our short term here, the next month or so, or really the next week, I should say, in this first graph, you can see pretty much, below average precipitation expected. This is that La Nina effect that a lot of meteorologists and climatologists are talking about. I don't know enough about La Nina, El Nino to get into the specifics, but I do know La Nina bringing a much drier South American and Southern Hemisphere weather pattern to, is the expectation, in the almanacs and everything else. So you can see here that we're getting almost no rain in the forecast here out of the next week. However, that does shift in the 8 to 14-day forecast here, where they are expecting upwards, of 30 millimeters of rain to be expected to bring some of that moisture content back to the soil in an otherwise pretty dry condition. Going out for the next week, you can see here in this bottom chart how this big red section in the Mato Grosso region and down through some of the southern states for Brazil is looking fairly dry, and we are only going to be in about the 5 to 10% of normal rainfall over the next week. So there are some shifts in a few of the forecasts here that suggest there might be a little bit more rain than that. But the next figure we'll look at here, the 7-day accumulated precipitation, very little rain has fallen over the last week to begin with. And then the following figure here, over the last 30 days, even less rain has fallen. It's almost, look at that. It doesn't matter if it's a week or 30 days back. For an area of the world that we consider rainforest and should be, well, it's not almost the rainforest or up north, but this main growing region, the Mato Grosso region, has been getting very little rain into their planting season, and it's not very good for soil moisture content at this time. The anomaly here that we're seeing is below. Slightly below to 25 millimeters behind what we would expect at this time of year. So we will want to see that pick up to have a little bit more confidence in what's going on there. So with that being said, let's take a look now while I've got this chart up. Don't care about that. Let's take a look at the dollar index to begin with. I apologize, I don't know why this keeps switching over or keeps flipping on me. Hopefully it will stick here. Daily. Want the continuous contract, or just the nearest for now is fine. There. Want to show how we came down here to test this 55-day move. Well, if this doesn't want to stay, I'm not sure we're going to be able to look at this chart for very long. But the point here is that the dollar index was down on the day, has now reversed that lower, reversed higher, and has tested this 55-day moving average. Wanted to point out how the dollar has had this bullish crossover event. First, the 55-day moving over the 200 and 100-day, the 100-day moving above that 200-day. So we've gotten a golden cross event. Now, when we take a step back for the dollar index, I don't know why this keeps slipping. We are expecting the dollar, any kind of rally here to find resistance, probably in that 94 to 96 area. But this is a big reason why I've been a little bit maybe leaning towards the bearish side on the grain charts, because this time of year with harvest lows coupled with what we're seeing in the dollar index suggests that we might end up having a walk back on some of our export expectations. I'm just gonna, I guess, leave it here and move on to our other charts, because it just keeps flipping on me. I'm not clicking on anything. But nevertheless, we're still in this uptrend that began since May in the US dollar. We would need to fall below this 55-day moving average around 92.40 around the lows of today. And I think that today is a little bit of a reversal structure here from the downtrend we've had since last week, might be enough to reverse this market higher. So the dollar does pick up, and we see it push back up to those highs. Alongside a drop in grain prices, could be expected at this time. So let's begin today with corn. December corn. Let's take a step out to the 4-hour chart. I would have loved to have looked. Maybe my other chart will be kind to me just for a moment while we at least look at where those larger time frame. Some of these larger time frame moving averages are. Again, the 200-day for December corn. God, I'm really sorry about this, everyone. Is down around 501. We're starting to break down inside the range. We came down to a low of 525 on the day. We're below that cluster of moving averages we looked at last night. 551 with the 55-day, 556 with the 100-day, and that 18-day moving average turning lower now around 554. So any kind of rally back, I'm expecting those to hold as resistance still. Today's recovery only got us back up to the lows from our prior lows here, but we can look at all of this on our other chart here, and we'll come back to the beans in a second to look at where some of those larger time frame moving averages are. Many of you have seen those if you've been watching my videos. We cover those every day, just to give a good idea of where some of those bigger, longer dated things are. So with that being said, we've got a bounce here today and a good short covering rally off of lows of the day from 525. Yet again, you can't really argue with the fact that this could just be a larger range still playing out and the market finding its way off of the low end of that range. However, breaking below that trend line support that we were holding. Give me a second while I get the chart over to where we need. There we go. From this, from last 2 Mondays ago's lows through the lows from last Friday, we broke below that trend line support. Talked about this yesterday. We came back up, didn't really even test into that area, but we did test the lows from Friday as resistance before falling back down, making a new low. Now I'm heading lower lows and lower highs. And really 2 days of a range of 20 to 30 cents here from highs to lows. We only recovered in today's price action, going down to a 5-minute chart here. I'm going to remove this larger fib for a second. Let's kind of stick it up here because I want to pull it back down. But from today's highs to lows, we just short covered right up into the 50% of that range and held below yesterday's low. So I would anticipate personally this area as resistance now. Last night and yesterday we were talking about the 548 to 550 area, that broken trend line support now is resistance. That I just mentioned, that was through the prior day's lows, through highs, and this full 50% retracement. You can see it blue here. There's this 50% level of 547. We looked at that yesterday. I was anticipating the market maybe getting there and then rolling over. Didn't even get that high and rolled over. So arguably an even more bearish thing. And my other charts are going crazy. So I'm just going to flip over to the, don't know what's going on there. Flip over to our precipitation charts and just leave them there. All right, so again, from lows of the highs of the day to lows of today, that 50% area around 535 acting as an inflection zone now. We definitely need to draw some new trend lines against the highs here. Certainly through our prior highs, through the highs from Friday, the start of the day, on Monday, through the highs of today. Take that other high through here. We've kind of got a 540 to 539 trend line resistance at this point. Kind of a, as a little bit more time plays out here, that will be, slope down here and probably be around the 538 to 534 area where I see resistance at this time for December corn. Now, yesterday's full fib that has broken down, went down to its negative 61.8 line. You still, because the market was, in my opinion, respecting some kind of, this area of 558 is some kind of anchor where you'd start drawing that Fibonacci measurement from. I continue and pull that all the way down to the lows again. So, a full 50% retracement of this week's price action so far is up around 542. So still plenty of resistance, even if we start to get above the 535 to 538 area. You've got basically this 10 cents of resistance. And then, of course, as you work your way back out to that 4-hour chart, you start to see that there's that old downward sloping trend line that we failed to break above with that spike high of 594 with that WASD fake breakout. We settled and consolidated below it, fell back down below, and arguably we haven't been able to retest it up around 560. This market has been like a magnet going back to 550 routinely every time, up and down. 550 is the middle of this range. However, it's very hard for me to say at this point that we're going to go back up there, knowing that there's things like harvest pressure around the corner. The dollar index could continue to rally. I don't deny that bad weather in South America is going to be a driving factor going into the end of this year to maybe get supportive on price. But we are now into a demand market in the U.S. Supply is factored in on the charts, in my opinion. We've had an argument over yields. We're all within a 3 to 4, let's just say within 4, 2 in either direction of where the USDA or where Pro Farmer or where other yield estimates have come out. I don't think they're going to be that far off from these, which means that more or less the market has priced that type of yield anticipation into it. It's not trend yield, right? That ship sailed way back in May and June. And we haven't been looking for trend yield since then, which is a big reason why I think December corn has really held above $5, why we've failed to really hold below $13 in beans, but we'll get to how that might be changing here in a second. And now that we're in a demand market, high prices are demand destruction. High prices are the perfect issue when you have low supplies, or the perfect resolve for low supplies and a tight carryout, because it destroys some of that demand and people wait for the lower price before getting back involved. And that's all we're saying is probably going to happen here, is that the harvest pressure now that we anticipate seasonally is starting to weigh on the charts. Technically, we've failed to break out. It's starting to weigh on the charts. And now there's going to be a capitulation where the market might sell off, burn the long side of the market out, get oversold, and become a perfect example of a harvest low going into the end of this year. And over the next 2 weeks, we're going to continue to anticipate that happening. I thought it might happen mid-August. The charts have not been confirming that consensus, and so all I can do is sit here and look at the footprints in the sand and try to tell you and track where those footprints are going. And right now, the path of least resistance and the direction that they're facing is down. So with that being said, for December corn, watch these trend lines, watch short-term resistance into the 538 area, above that at 544, but I think that this rally should be probably sold. If you haven't had an opportunity to get some sales done above $5, this might be your last and your call to do so before, certainly if we start to break down further, a slide to $5 is going to happen rather quickly. And remember that all faithful 477 half gap that is still open on this chart. I'd love to see us to go down to fill that gap, maybe dip a little bit lower. That's the low-hanging fruit that we want to grab for reownership and for buying a harvest low if and when it comes. Again, back above 560 in this chart, we can start talking a different tune, but we got 26 cents to go before we get back up there and retake the damage that's been done on this chart. Okay, so next up we got November beans, and I think I figured out what happened here on my charts. My other charts, I think I turned on a presentation mode of sorts. Let's see if I can't turn that off and if that fixes it. Okay, fingers crossed here. Let's flip over and take a look at that daily chart of November beans now. The triangle, or that wedge-like structure we were in, at this point, guys, I gotta admit, I think it's breaking down. We had a breakdown of that trend line support that we've been looking at, drawn from our June lows through the lows from that WASD day that took us up, fake breakout of 1380s, and we come right back down below. We test back up and to the end of life September contract, which, by the way, that same rally we looked at in September, that yesterday's video I talked about how this was a short covering rally into the end of life September, which first notice was today. So now all those longs are out of the market. The market spent 3 days selling off, squeezing the longs. It squeezed the shorts that and all those puts that put into the money into the September option expiration on this Friday. Squeezed those new futures, those new shorts that were in the market. 4 days worth. That means that like any kind of margin call that goes on in this market, they get blown out, and then the market sells off. I mean, if you want to talk about a market that wanted to cause the most pain to the most amount of people, September Beans is doing it right now. Squeezes the shorts, squeezes the longs, and goes out here into first notice back below $13. That is a nasty, nasty looking chart, and $1.60, 80 cents up, 80 cents down, round turn trip that decimated anyone still in September. And meanwhile, right, we were watching the spread market there go from almost even money up to almost 50 cents over, back on down to even money now. Just a brutal, brutal, brutal price action in every regard. With that being said, December though, let's put the September behind us. It doesn't even matter to me at this point. 1253 200-day moving average aligning with those June lows. Broken record. I've been talking about that level in this market, wanting to come down to test that as a highly technical, visible area. I think that's in the works now. We're holding trendline resistance against the highs. That level is going to be around the 1340 area. And again, we're going to need to see this market get up to test those moving average, cluster of moving averages, just like corn. 18-day up at 1330, 55-day at 1339, and the 100-day moving average up at 1352 at this time. So while we're in no man's land between them, path of least resistance feels like we're going to go lower. We're very close to that 1277 low for the month of August, which if we take out the month lows of June aren't that far behind. The 1253 lows aren't that far behind. And then this level down around $12 where we held a low here in April, that could be an interesting level that we test. Now, why do I pick that level out on the chart? Let's go to our 4-hour charts for November beans, and we'll take a look at some of the larger equal leg measurements that I've done. So talked about this level in the past, 1480 down to the 1240 lows. That $2.40 drop, if you extend it here from the 1423 high or the 1382 high, extend $2.40 off those, you're going to get it 1183 and 1138. So let's call it the 1180 and 1140 equal legs down. So this is a equal legs measurement, 100% extension down from our range break would take us down to that area. Full 50% retracement, stepping out to a big daily chart here so you can see from the 826 half low to the 1480 high, comes in at 1150 as well. So you've got this cluster of fib measurements that I like to call a Goldilocks zone, down at below $12 but above 1140. Interestingly enough, it also happens to be the area of congestion that earlier this year, between January and February, we fought to break out of that $12 area, broke out of it, came back, tested as support, and then rallied on up to 1480. Very natural for this market to come down, test that area, re-find the demand that we found earlier this year at those prices, and then continue on higher. Going down again to the 4-hour chart, the full 50% retracement drawn for the month of August from 1380 to 1379, but 1380 down to the lows here of 1277, failed to break the 1340 resistance and the highs there. That was a 50% to 618 inflection zone. We tested it 3 times, and even this week we had a good old test of it on Monday night and a sweeping reversal outside day to the downside, starting this sell-off. That old trend line that was drawn, I'm going to take it off this chart now, but it was drawn from our prior lows from the month of June through the lows pre-WASD and everything we talked about that we broke below to take us down to the lows of August. We tested that as resistance, broken support as resistance. It's what we call a kiss your mother, a KYM setup, market reverse lower. So you've got this whole cluster of reasons why the market failed to break out of 1340. Trendline resistance, 50% fib, every moving average you can throw on the daily chart. I don't know why you want to fight that kind of technical nature of the market, even in the face of these fundamentals. When we've been arguing over the same fundamental yields for the last 3 months, nothing's changed to break beans out above $14. So something's got to give. If a market is not respecting the fundamental narrative that we're building for it, it's got to be doing something on the technical side. And that's what we've been really focusing on these last several weeks. The technicals are playing out. The trend is starting to go lower. And at some point, the fundamental balance sheet equation that says beans are at such incredible tight carryout, we shouldn't fall apart and go lower for very long, that will come back. But right now, every moment we've been spending above $13 for soybeans, just like we've spent above $7 for maybe wheat, has been destructive to demand. And we need to fall to find that demand. Full 50% retracement now from our recent high at 1340 down to our lows of today comes in with resistance probably around the 1312 area, 1310. So watch that area. I'm going to move this fib out of the way and just kind of put it up here. I'll pull it back on the charts, but there's a lot of lines here that I don't want us to, I want your eyes to see. I'm also going to I'm just going to remove that fib for a second because I want to show you the 50% retracement was our from our 1326 highs from yesterday's session to the lows of the day is what held overnight. We went down into its negative 23.6% retracement. I'm going to remove that off the chart because that technical pull is done. 50% retracement for today from our 1312 highs of the day down to the 1283 lows. That comes in with an inflection zone of resistance into the 1297 to $13 mark. Kind of aligns with the trend line resistance we're seeing here formed from yesterday's session high, day session, not the night session high through lows. That night session high trend line is coming around 1301. So I see a pretty good inflection zone right around 1297 to 1301 for resistance for beans. It correlates with yesterday's low as well. And by the way, that 1308 area is an important level because that was our old low for the month of August that we broke below and kind of failed to break back above here in last night's trade. Fell back down. So watch out for the $13 area as resistance. Maybe could get as high as 1320, or excuse me, 1310. And again, that 1310 to 1312 resistance area is coming from the full Fibonacci retracement from our 1339 highs down through the lows at 1283. So watch, the next area of resistance on this chart, probably in that 1312 to 1320 area. If it gets back up there, but the way this trend is starting to pick up steam and the big outside sweeping reversal from yesterday and today's downside confirmation suggests to me we're not going to get that high. We're going to have a dead cat bounce. And if it rolls back over, we're going to be taking out a 1283 low and potentially that 1277 low from the month of August. And below there's not much in the way to our lows from June. And at that point, we probably would have some kind of capitulation and fire sale type of mentality taking us lower down towards $12 and maybe even as low as $11.40. And again, I'm not hoping for this type of price destruction, but I do believe it will be short-lived and very much board related. It'll happen so quickly, cash markets won't be able to really adjust to it too much. And honestly, it represents a pretty good opportunity for reownership for anyone that's gotten good sales done above the $13 and $14 mark for beans this year. So that's probably where Wednesday's video will really focus on. We'll switch our mentality from looking at some of the puts we've been looking at and some of the short-dated ways of capturing some downside and start focusing on how do we now put some reownership strategy into work. Maybe not right away on Wednesday, or Thursday. Hey, we got 2 more days. We could break all the way down to those levels by then. It'd be a really fun webinar to do talking about that from those levels. But I feel like it will be sometime between this Thursday and the following Thursday that will really get those that price action will start to happen. All right, I do want to touch on wheat today too. The wheat in the Chicago contract. Let's look at December real quick. September's off the board. I don't have much on this chart yet. I haven't done my homework to get these trend lines all updated. But I do want to point out, and a lot of people have been mentioning the fact that there might be a bit of a head and shoulders pattern here. This is your neckline that we actually broke. You could argue we broke below here today. You got a left shoulder here up into that 748 area, the right shoulder here up into 745 with your head at 786. Now, a full breakdown of this type of structure would suggest we're going all the way back down to the low $6 mark, which which arguably makes sense. Chicago wheat's been in a big old range here between $6 and $7.86 and $7.70 for some time. Every moment I feel we spend above $7 without seeing some true demand. We're just destroying demand. And then when you add on the fact that the US dollar might be in a bit of a rally right now, that's also going to continue to weigh on our wheat markets at this time. So trendline resistance now drawn from our highs through those highs here of this week. Obviously, the 730 area, you'd expect to see that. This recent rally that we just saw today in Chicago wheat is taking us up into the 726 to 730 area. That's a 50% retracement from our 745 high down to the 707 lows of today, just for the December contract alone. And again, we are just coming up to broken support here at that 720 area now as resistance. So if wheat finds a little bit of a top here between 724 and 730 and rolls back over, I think it's a pretty good opportunity for wheat prices to start and continue their trend lower. We've got a lot. This was a pretty impressive reversal. Don't get me wrong. Look at this daily candle for wheat. Finished meagerly positive in what could be considered a doji or a big reversal. But I also fear that this type of candle and this type of structure might actually be a bit of a bull trap at this time, because it flies in the face of, remember that US dollar candle that we looked at from today. It doesn't make much sense that wheat and the US dollar, if I flip that chart over here, doesn't make much sense that wheat and the US dollar here over the last couple of weeks have been moving in a positive correlation. Usually these are inverted. You get, as wheat prices go up, the US dollar is usually dropping. And particularly when we get into this time of year where we're in a true demand environment because production's already on the books. We're through into our new crop season, and we're talking about planning for next year. This has nothing to do with supply at this point. It has everything to do with demand. And the U.S. dollar, if this reverses, we might see a tug of war here between wheat and the U.S. dollar, depending on which one ends up rallying. If the dollar does pick up and rally, wheat fails to break out here, we might see the market roll over for wheat. And again, I think maybe the safety mechanism here is that we dip below $7 on December wheat here. It's probably a pretty good sign that we're going to be heading lower, maybe head down to test larger trend line support and the low end of this range, which from our 514 contract lows through the lows here of July would take us down towards 640. So maybe the 20 cents here is worth sacrificing and waiting for confirmation of a low break of the lows here for August. But I do think any kind of rally here in wheat is probably going to stay below 740. Not saying it couldn't get all the way up to a 50% retracement off of its prior highs here. But it is worth noting that wheat did come down and almost test into the 50% level and down at $7. That's from our 620 low to highs after. So, the fact that we've broken lows, came back up to test them as resistance, can't disagree that this one-day reversal might be enough to spark the market, break through trend lines, and take us way higher. But it also could be a bear trap, a bull trap at this time, particularly when you can also consider the spread between Chicago wheat at 724 and December corn at 534 is $1.90 wide right now. That's a very wide spread for the two. And corn trending lower, wheat trending higher with the dollar rallying. Somebody's a liar, and I don't think wheat is the one leading the way and trying to drag the rest of the row crops higher at this time. So, hope you've enjoyed today's Strategy of the Day update, everybody. That covers everything I wanted to go over. Any questions or comments, feel free to leave them in the comment section below. I love hearing from you guys. Want to know what we can add to this video and cover more to that you'd like to see. Of course, don't forget to sign up for our Zaner Daily newsletter or for that Wednesday or Thursday webinar at 2 p.m. where I go over our Strategy of the Week forecasts and I trade ideas and some actionable strategies for you to take part in these markets. Reach me at 312-277-0110. You can find me on Twitter, right here on Facebook, or shoot me an email at dhussey@zaner.com. Have a great day, everybody, and we'll be back with you as price action develops. Take care, everyone.